We're analyzing Vale S.A, stock ticker VALE, to see if this high dividend yielding stock is on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Vale. Then we're giving a final rating to the business. The last time we looked at Vale, they were a Select 6 stock. Is that still the case? There will be a key bonus metric along the way that just might be the tipping point when analyzing Vale for your stock portfolio. Before we get into these valuable metrics, let's understand Vale's stock performance. Right now, Vale trades for $14.05 per share. Year to date, their stock price is down 12%. Right now, Vale pays a huge 7.18% dividend yield, which would be in addition to their annual return. In their last 5 years, Vale's stock price is up 10% overall. In the last 10 years, their stock price is up 2% overall. Going back prior to the global financial crisis, Vale is compounding at 3% annually over the last 18 years. Their stock price is up 77%. Keep in mind their average dividend yield throughout this time is in addition to these returns in their stock price. Vale trades right in between their 52-week low and high. They're a big business. They have a $64.5 billion market cap. But the burning question is, why should we be paying close attention to Vale? Vale is a large global miner and the world's largest producer of iron ore and pellets. In recent years, the company has sold non-core assets such as its fertilizer, coal, and steel operations to concentrate on iron ore, nickel, and copper. Earnings are dominated by the bulk materials division, primarily iron ore and iron ore pellets. The base metals division is much smaller, consisting of nickel mines and smelters, along with copper mines producing copper in concentrate. Now that we have that background on the business, let's get into the numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. The average publicly listed business earns about a 7% return on capital. Looking for a benchmark that's double this allows us to build in margin of safety based off the quality of the business. Vale's returns on capital as an iron ore miner are going to fluctuate with the pricing of iron ore. That's reflected here in their returns on capital. Commodities have had strong pricing in recent years. Averaged out over this time, Vale's earning 33% returns on capital in a given year. That's more than 4.5 times better than a typical business. This is a huge check starting off on metric number 1. Metric number 2, we're looking for growth to support these high returns. We want to see growth in their revenues, earnings, and free cash flows. All 3 of these have to be up for this to be a check. This is all or nothing. We're including their numbers up until today in our calculations here. During this time, Vale has grown their revenues by 21%. Their earnings are up nearly 2.5 times. However, the company's free cash flows are down. They've declined by 20%. Looking at their cash flow statement, Vale spent heavily on capital expenditures in recent years, which contributes to their free cash flows being down. This is an X on metric number 2. Metric number 3, we're looking at the business from the view of an individual shareholder. We want to see earnings per share growth in the last 5 years. As we learned, Vale has grown their earnings by 2.5 times in the last 5 years alone. Vale has also bought back 12% of their shares. These big buybacks are likely a good thing for long-term shareholders, as it increases your ownership percentage in the business without you having to spend a dime. Value can either be created or destroyed through share buybacks. We want to make sure they're buying back below their intrinsic value. Later in our analysis, we'll use 2 different methods to estimate that intrinsic value, so stay tuned. Because of their share buybacks and this earnings growth, this is a check here on metric number 3. Vale's grown their earnings per share. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. Their free cash flows are down and the company's bought back shares. This puts these 2 at odds. However, the decline in Vale's free cash flows are going to outpace their share buybacks. This means this is an X on metric number 4. Recapping where we stand currently, through 4 metrics we're split evenly. We have 2 checks and 2 X's for Vale. During economic downturns, it's overly levered businesses that are at the greatest risks of poor outcomes. We want Vale's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow they produced in their last 5 years. Vale ended their last fiscal year with $10.5 billion in net debt. Right now, they've added on to this and they have $11.1 billion of net debt. In this last 10-year time frame, Vale's produced nearly $53 billion worth of free cash flow. This is huge compared to their debt loads. It looks like Vale is easily able to support their net debt position. This is a huge check on metric number 5. Before we get into the first of 2 different ways we'll be valuing Vale, it's time for our bonus. As our bonus, we're looking at Vale's dividend profile. Right now, Vale pays a huge 7.18% dividend yield, way above the dividend yield you'd receive from an S&P 500 ETF. People make mistakes all the time by blindly chasing dividends. We want to see that Vale supports their dividends using their free cash flows. Looking at these last 5 years, that's been the case for all of them. Vale's increased their dividends quite a bit since 2019. It looks like management also adjusted their dividend payouts based off of the free cash flows they were bringing in, meaning their dividends into the future heavily depend on their cash flows. As management cut these from 2021 to 2022 when their free cash flows declined, this is likely prudent capital allocation. Right now, Vale's dividends are supported by their free cash flows, but they're paying out a very high dividend yield, especially with reinvesting back into the business. While this is a snapshot of their last 5 years of performance, this is no guarantee for the future, but it looks like Vale's dividends are supported by their free cash flows and that management likely adjusts these as necessary. The big metric of them all, metric number 6, we want Vale's average 5-year free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we'll be estimating a fair value for Vale. Right now, Vale has a $77.5 billion enterprise value, which accounts for both their market cap and their net debt position. It gives a view of Vale similar to it being a private company. We learned in their last 5 years, Vale's produced nearly $53 billion of free cash flow. That's more than 2/3 of their enterprise value right now, meaning in an average year, Vale produces $10.5 billion of free cash flow over this time. When their $10.5 billion of average free cash flow are divided by their $77.5 billion enterprise value, we get a 13.5% average free cash flow to enterprise value yield. On a current basis, even though Vale's free cash flows have declined, they've still produced $7 billion worth in their last 12 months. When that's divided by their $77.5 billion enterprise value, we get about a 9% current free cash flow to enterprise value yield. Those are both significantly above the yield of the 10-year treasury, coming in well above the risk premium we'd be seeking. This means this is a check here on metric number 6, but don't just run out and buy the business. We still want to come to a more concrete estimate of a fair value per share for Vale. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Vale, which takes us on to using a discounted cash flow model to come to an estimate of their fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Vale's had a low degree of business predictability in their past. As an iron miner, they operate in a cyclical commodity business. Commodity pricing has been high recently. We're trying to smooth their cash flows out, and we're taking an average of their last 3 fiscal years worth of free cash flow. Then we're using historical assumptions to grow these into the future. It's up to you to figure out if these assumptions are accurate or not. Assuming they grow their average 3-year free cash flows at a rate of just 1% annually for the next decade, then assuming these free cash flows decline at 1% annually for the following decade, if we add in the company's tangible book value, which gives an estimate of their net worth, if we're seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for in addition to his margin of safety requirements, from today's valuations, it looks like a potential fair value per share for Vale is around $23. There are key points to keep in mind. Vale has not been a predictable business in its past. That could also be the case into the future, and this affects our assumptions. This discount rate is an estimate of total returns to shareholders. It would already include the company's big 7.18% dividend yield. Their stock price would not be appreciating by this whole 15%. Again, commodity pricing has been strong and Vale is a cyclical business. You need to have some insight into the supply and demand of the iron ore commodity industry and understand how Vale is approaching capital allocation to truly get an insight into the business. Most importantly, this analysis isn't financial advice. It's not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. In just a minute, we'll talk about our final rating for Vale, but we have to address something first. We've covered the numbers, but the qualitative aspects of this business are just as important. What are they? Starting with the factors supporting a potential long thesis. Number 1, Vale could benefit from efforts to decarbonize steelmaking. Steelmakers prefer higher grade inputs such as Vale's iron ore, as they require less metallurgical coal and result in lower carbon emissions per metric ton of steel produced. Number 2, Vale's high quality ore with iron content of around 63 to 64% could attract significant premiums relative to the 62% benchmark. Number 3, Vale's lower unit costs relative to producers in India and China, as well as high-cost producers such as Anglo American, allow it to remain profitable even in depressed price environments. We'd be remiss if we didn't cover the negative aspects of the business as well, the qualitative factors supporting a potential short thesis. Number 1, Vale's investment in non-ferrous business lines such as coal, nickel, and copper have been pro-cyclical and expensive, destroying shareholder value. Returns have been poor and have weighed down overall group returns. Right now, Vale's taking bids for a stake in its base metals division, with Saudi Arabia's PIF bidding $2.5 billion. Number 2, the Brazilian government occasionally reviews mining royalties, which could allow it to extract farther value from Vale's iron ore assets. Number 3, it's believed China's real estate and infrastructure-driven economic growth has likely peaked, and prices for materials such as iron ore could decline into the future. There you have it for a balanced perspective of some of the qualitative aspects of the business. Now it's time to give Vale our final rating. In analyzing Vale S.A, stock ticker VALE, the company looks like it has low-cost producer advantages due to its enormous scale and its efficient, high-quality iron ore operations. They earn exceptional returns on capital. They've grown their revenues, earnings, and bought back shares in the last 5 years. Even though their free cash flows are down, they'll still easily support their net debt positions. It's worth reiterating this analysis isn't financial advice. Vale looks potentially attractive on both an average and a current free cash flow to enterprise value yield. They've supported a dividend that's grown in their last 5 years using their cash flows. They do pay a very high percentage of their free cash flows as dividends, and this has come down year over year, meaning Vale adapts their dividends based off their free cash flows. You'd need to understand where their cash flows are at to understand the returns to shareholders. When we performed our discounted cash flow analysis from today's valuations using those assumptions, and if you're seeking a 15% rate of return, it looks like an estimate of Vale's fair value per share is around $22.50. That's well above the company's current stock price. Be mindful of the factors we mentioned around the business. Looking at all the factors of our analysis, Vale looks like a very strong candidate for further research. Again, this is not a buy or sell recommendation of any security. Consult with your financial advisor before making any investment decision. If you enjoyed today's video, be sure to like the video, subscribe to the channel for more stock analysis videos, share your thoughts about Vale, and let me know what business you want me to look at next in the comments below. Thanks for learning more about Vale with me, and have a great day.